Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Google stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Google is a search engine, online advertising, cloud computing, and e-commerce company. It has been referred to as the most powerful company in the world and one of the world's most valuable brands due to its market dominance, data collection, and technological advantages in the area of artificial intelligence. It is considered one of the big 5 American information technology companies alongside Amazon, Apple, Meta, and Microsoft. Google owns YouTube, Waze, Fitbit, and many more brands. The company is headquartered in Mountain View, California, and was founded in 1998. The ticker trades on the Nasdaq, Deutsche Börse, Mexican Bolsa, London Stock Exchange, Zitra, Vienna, EuroTLX, Swiss, Sao Paulo, Buenos Aires, Bulgaria, Colombia, Lima, Borsa Italiana, and Santiago Stock Exchange. Let's get started with the model. This is a large cap company, 1.3 trillion market cap. They're trading at 103 a share, and they have 12.8 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. And they have amazing free cash flow growth from 2019, 31 billion, way up to 67 billion in 2021. It did drop to 60 billion in 2022. That's just funny saying they declined to 60 billion. That's just an unbelievable number, 60 billion of free cash flow. Net income is the profit or loss on the income statement. It's revenue minus expenses. That also grew a lot from 34 billion to 76 billion, then dropped to 60 billion in 2022. Revenue grows every year from 160 billion way up to 280 billion. This is their company's income statement. The top line is the revenue, the sales, and they had 280 billion in 2022. Let's look at a breakdown of their revenue. 160 billion of the 280 billion is from Google AdWords. YouTube is 29 billion, and the Google network is 33 billion. So the bulk of their revenue is from advertising, 220 billion. Other Google activities is 29 billion. They have a pretty big market share in cloud computing. They generate 26 billion from that. A little less than half their revenue is in the US, 130 billion. Europe, Middle East, and Africa, that's 80 billion, 29% of their revenue. Asia Pacific is 47 billion, that's 16% of their revenue. Their revenue percent in America is the highest at 48% when compared to 2020 and 2021. For EMEA and APAC, it's lowest in 2022. Let's go back to their income statement. Below their revenue is cost of revenue. These are all the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that went from 90 billion to 156 billion. Then below that is their operating expenses. These are all the expenses not directly related to generating the revenue. That's 82 billion. Gross profit minus operating expenses gives you your operating income. That more than doubled from 36 billion to 75 billion. It is lower than 2021's number with higher revenue, so their margins are getting worse. They don't have too much debt. They only spend 350 million of interest on their debt, which is higher than prior years, but they receive a lot more interest on their investments. They receive 2.2 billion of interest. Then you have other income and expenses. These are all the gains or losses not part of the company's core operations. They had a loss of 5.3 billion. This is likely an asset impairment. Then your pre-tax income, your taxes, and the bottom line of the income statement is your net income, which is higher than 2019 and 2020, but a bit lower than 2021. That's mainly due to other income and expenses. They had a gain of 11 billion in 2021, a loss of 5 billion in 2022. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. So you can see they generate a ton of cash flow, 91 billion in 2022, slightly lower than 2021, but still an amazing number. They spend a lot on CapEx. They're always reinvesting back into their business to grow it. They spent $31 billion in 2022. Operating cash flow minus CapEx gives you your free cash flow. They don't pay a dividend, but another way to reward shareholders is to buy back stock. When a company buys back its own common stock, that decreases the shares outstanding and makes your shares more valuable. Look how much stock they buy back. $59 billion in 2022. $50 billion in 2021, $31 billion, $18 billion. They do add a lot of debt, $53 billion in 2022, but they pay down more debt than they added. They did add a lot of debt in 2020. Let's look at the capital structure. $250 billion of equity, $30 billion of debt. They're 90% equity, 10% debt. And they could pay off all the debt with the cash on their balance sheet and still have $84 billion of cash left over. I use the middle whack on Finbox, 10.3%, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $1.2 trillion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $1.1 trillion. We divide that by 12.8 billion shares. And we get a calculated stock price of $84. They're trading at 103, so they're trading at a 22% premium. It's a sell according to the model. Their revenue forecast for 2025 is $372 billion. For 2024, it's $335 billion. And for 2023, it's $300 billion. I continued this trend into 2026 and I got $411 billion. That's how I got their future revenue estimates. To get their future free cash flows, I need to see what percent of their revenue they convert to free cash flow. So I summed up these 4 free cash flow numbers and I divided by the sum of these 4 revenue numbers, and that's 23%. So I multiplied their future revenue estimates by 23%. That's how I got their future free cash flows. The website Simply Wall Street is a lot higher than me. They're at 146. They're saying the stock is 30% undervalued. 8 analysts priced this stock and the average price target is 125, the lowest 115, the high is 155. Another 41 analysts priced this stock and the average price target is 126. So they're saying it's 25% undervalued. This is where the stock has been trading the last 5 years. So it peaked at about 150 in the beginning of 2022, end of 2021. But a lot of tech stocks have gotten killed the past 15 months. It did fall to below $90, but it's come back to triple digits. So if you bought the stock in the beginning of 2021, you're pretty much flat. If you want to know how this stock compared to the other FANG stocks, the F, which is Meta or Facebook, that's up 29% in the past 5 years. Apple is up 280% in the past 5 years. Amazon is up about 30% in the past 5 years. Netflix is up 11%, and this stock is up 100% in the past 5 years. Their stock pretty much moves with the market. They have a beta close to 1. It's down 28% in the past 52 weeks, while the S&P is down 14%. The 52-week low is 83, the high is 144. And the stock is trading above its 200-day and 50-day moving average. This is a really popular stock. Well over 30 million shares are traded each day. 63% of the shares are held by institutions and 1/4% of the shares are shorted. They've done 4 stock splits. The most recent one was a 20-for-1. Then they did a close to a 1-for-1 in 2015 and a 2-for-1 in 2014. If you put $10,000 into this company 9 years ago when they started trading, you'd be at $37,000 today. In the beginning of 2022, you would have been over $50,000. The CEO's annual salary is only $650,000, and it looks like the total compensation package is just a little more. At one point, their total compensation package was about $270 million. There has not been much insider trading. There's only been one sell for 1,230 shares by Francis Arnold. 65% of the companies held by institutions, 22% by the general public, 13% by insiders, and a really small amount by the government and private companies. This company does employ a lot of people, 190,000 employees, and it pretty much goes up every single year. The biggest shareholder is Vanguard at 7%, BlackRock at 6%. The founders, Larry Page and Sergey Brin, they own about 6% of the company, and State Street 3%. The best way to look at ratios is to compare them to companies in the same industry. There are 63 companies in the same industry as Google, and if Google has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So they spend a ton in CapEx like Meta, well over $30 billion. But they're almost triple the size of Meta. Most tech companies have a low debt to equity ratio, because you generally don't need too much debt to run a tech company. Manufacturing companies need a lot of debt, and they generate more free cash flow than almost all the other 62 companies combined. They're the biggest company in this industry, and they've been the biggest for a long time. Their price to book isn't so great. Their PE is a little better than average, but for the longest time they had a PE over 100. Now their PE looks pretty good. Their price to free cash flow is better than average. Price to sales is worse than average. They generate lots of revenue. A reason the stock has been coming down is they're not growing as much as they used to be. Their 5-year annual revenue growth rate is 21%. But when your revenue is $280 billion, it's hard to grow at big percentages. And they have a really good ROA and ROE. ROA is net income over assets. It's how well you use your assets to generate a profit. ROE, net income over equity. It's how well you use your equity to generate a profit. Equity is on the balance sheet. It's assets minus liabilities. It's the value of your company according to your balance sheet. To summarize, I have them trading at a 22% premium, but this is such an amazing company. They have a huge market share. They have more customers than pretty much any other company in the world. So for a long-term hold, I think it's great. In the short term, there could be some volatility. Just like owning any stock or owning the market index, there's always going to be some volatility. Once they start paying a dividend like Apple, then they're going to get even more investors, the dividend investors. I rank their free cash flows 8 out of 10, their revenue 10 out of 10, and their ratio 7 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.